much. Now, with the disclosures that we've got so far from ICICI and Axis, okay, I think we're just going to fix the audio line in a bit from now. I think my audio is being picked up by the mic, but we should be able to fix that. 7866 on the Nifty. Okay, I think my audio was lost in between, but now I hope that you can hear me. 0.75% higher. So let me get Nitin back in. Nitin Kumar is research analyst, institutional equities with Prabhudas Lilladher Private Limited. Nitin, thanks very much. Good to have you here. So stocks for both ICICI and Axis continue to remain sideways. No real activity, no real action. What are markets really building in here, Nitin? After the stress that has been provided, stress that has been shown, and of course disclosures, which generally has been well received.
Disclosures from the banks was highly appreciated, but then Street was expecting some bit of normalcy in asset quality in FY17 after having gone through the AQR exercise and pretty elevated level of slippages. But the watch list that both the banks have released, and in fact Axis guided for almost the potential 60% slippage from that watch list, that looks to be a pretty sizable number. So the earnings normalcy, the asset quality normalization that the Street was expecting is looking to be difficult. And Axis has indicated that the slippages can be front-ended. On the other hand, ICICI has given a stressed asset list of close to 45,000 odd crores, and add to it the restructured assets of another 8,500 crores. So while this list includes both funded and non-funded, so we cannot directly compare Axis to ICICI on this front. But there are signs that in FY17 also the slippages may remain elevated, and as such it will continue to remain an overhang on the earnings growth for both these banks.
Yeah. What is the single biggest, according to you, the single biggest driver of valuations, according to you, for these banks now?
I think it will be some stabilization on asset quality because if you look at operational line, both these banks are doing well. Axis is doing close to 3.9% margins. On the domestic side, margins are close to 4.2, which is highest in past many years. Likewise, ICICI also is doing good on margins. The operating profits growth is pretty okay for both these banks. But it's just the provisioning line which is very high. The credit cost for both the banks have increased substantially, and this has resulted in modest double-digit growth for Axis, while for ICICI, because of the terrible 4Q also impacted due to the one-off provisions that they have made, it has resulted in a very subdued net profit growth. And I think this trend may continue for the next 1 year.
Just one point. Would you believe that the asset quality review by the RBI has been comprehensive, so as to essentially, put in front of us all the stressed assets? Or do you think even the RBI, the regulators, while forcing these banks to do a review, have been conservative?
I think though it initially looked like that the RBI's activity was fairly comprehensive and it would encompass potentially all sorts of stressed assets. But looking at the guidance, it looked like while RBI has certainly brought in some uniformity in terms of asset classification standard and has guided banks to make higher provisions against certain stressed assets, wherein the probability of turning them into NPL is fairly high. I think there are still some other assets which are on the books of the banks, individual banks, and wherein those assets may still slip. So though RBI, what we have been told is has not asked banks to downgrade them as such, but I think banks are now getting more proactive and forthcoming in getting rid of those assets also.
Okay, fair enough. Is there any reason at all? Some have suggested, these kind of banks which are beaten down in terms of valuations could provide better returns over a 12-month perspective as against, a HDFC or a Kotak. Is there? What's your view there?
So we believe that the near-term upside in both these names are because investors will be looking at their quarterly performance very closely. Axis has guided that the slippages can be front-ended. ICICI has also given a big list in terms of the potential sources of stress that may come. and the investors will drift towards the retail banks, which are still offering anywhere around 20 to 25% sort of earnings growth. So over there, you are getting clean earnings growth without any issues on asset quality. I think the premium for these retail banks will continue to expand over these wholesale banks. But over the medium term, say maybe 6 months to 12 months down the line, if you get any sense of improving asset quality in FY18E, I think the potential of which is fairly high today, then there could be some good money that one can make in these project banks. So, but until for the next, I think 2 quarters, the upside is very limited in both these names.
Okay, fair enough. Nitin, just a quick word on public sector banks, which will start reporting numbers as well. And let's just stick with, say, PNB, SBI and Bank of Baroda. Actually, forget Bank of Baroda, where they already said they provided for everything, right? Last quarter. What about SBI and PNB? What should we expect?
I think some of these PSU banks will report very weak earnings, and we expect losses also to come in this quarter for a couple of PSU banks. So I think this quarter should ideally mark the trough in terms of asset quality for the PSU banks. But the street will be watchful of if these banks also were to guide for any watch list or any elevated level of slippages for the next fiscal. It was not the expectation as such before the season started, but now with 2 private banks coming in and guiding for elevated levels of stress, I think the street would look for the management commentary on the asset quality going ahead. But as such, this quarter I think should be pretty weak for PSU banks.
All right, Nitin, thank you for your time. Good having you here. Appreciate you joining in with that view. Nitin with Prabhudas Lilladher with that perspective this morning. We'll take